Thank you and welcome to today's session. We'll be getting started in a moment. We're just confirming the audio. We'll be getting started in a moment. Thanks you, and we'll let folks join. So looks like the audio is working, so that's great. So thank you so much for joining. So I see that people have entered. So thank you for joining. Please ask questions in the chat, and I will answer those questions as we go through the slides. We've got a lot of great slides to go through, so some of the information might be answered in later slides, but we can go over things multiple times, is no problem. I would ask you to please like this video. Please subscribe to our channel for more videos like this so you can get notified of our weekly webinars, and you'll be able to just click on the link to watch it as a recording. So today's topic is a very popular topic, which is making mega backdoor Roth contributions. Specifically, the presentation is geared towards people whose self-employed business is organized as a sole proprietor, a single member LLC, or an independent contractor. So someone who receives a Form 1099 miscellaneous, or it's now been renamed the NEC form. So let's get started. So again, the focus of the presentation is sole proprietors, single member LLCs, if you receive and report your income on Schedule C, if you're an independent contractor. Last week, we did a presentation for S corporations, so you can go to the channel and you can click on a link to that to watch that video. So again, please subscribe for notifications of future webinars or weekly webinars. So let's first start out as far as the reason to set up an account would be the benefits of a solo or of a Mega Backdoor Roth Solo 401k is being able to contribute high amounts to a Roth Solo 401k. A Solo 401k is always going to have the highest contribution limits for any defined contribution plan. So you can already contribute more than you can contribute to a Roth IRA. You could go up to, as you'll see, up to $19,500 or $26,000 if you're 50 or older into a Roth account. But with a Mega Backdoor Roth, as we see as we go through some scenarios, you could really get as much as, for 2021, $58,000 or even $64,500. But in order to be able to make those types of contributions, you need to, number one, be eligible to set up a solo 401k. So you have to qualify. And in order to qualify, in simple terms, you have to be self-employed with no full-time W-2 employees working for you. And then you have to have a solo 401k provider whose plan supports the Mega Backdoor Roth Solo 401k feature. So what does that mean? So that means that the plan allows for voluntary after-tax contributions and in-service distributions or conversions or rollovers, because as you'll see as we go through the slides, you will end up with multiple sub-accounts. So you have to make after-tax contributions to one sub-account and then you move it over to the Roth account. So the plan has to allow for those contributions and then has to allow for the move. You need to have very specific requirements, like with the multiple sub-accounts. You need a provider that's going to help you get those different sub-accounts set up at the financial institution of your choice, so the bank or the brokerage of your choice, and then is going to provide the ongoing compliance support, because that move from the after-tax account to the Roth account is going to be a reportable event. And I see that we've got some questions coming in, so appreciate that. We'll answer those questions as we go through the slides. So let's get through a few slides and then we'll field some questions. So the first issue to consider here is how much I can contribute. And so the baseline understanding is that to set the baseline understanding, we need to understand that the ability to contribute is based on different factors. So we've got those basic factors outlined here. One is your age. Another is what's your self-employment income, because you can't contribute more than you earn, right? So you have to have that earned self-employment income. Do you participate in another 401k plan or another retirement plan through a day job, like a 401k plan? What type of contribution are you looking to make? Are you looking to make employee contributions, employer contributions, pre-tax, Roth, etc.? So, and please don't hesitate to let me know if the audio is not coming through well, and we can go over concepts again. So in terms of, remember, one of the factors is your self-employment income. So that's where how your business is taxed impacts what that means. So again, this presentation, we're focused on sole proprietors, single member LLCs, people who operate their self-employed business as an independent contractor. So in that situation, your ability to contribute is based on your net income, which is reported on line 31 of Schedule C, after you reduce that amount by 1/2 of the self-employment tax. So, and we have a calculator on our website that will tell you what your self-employment, what 1/2 of your self-employment tax is, or we can help you figure that out as part of our, ongoing compliance support. One thing to keep in mind is that you don't want to consider W-2 wages from other sources. So you cannot use, if you have a day job and then you also have a side business, let's say you're an IT professional and then you also have a web hosting company on the side, you can't use the W-2 wages from your day job to justify a contribution to the solo 401k. It really needs to be based on your self-employment income. And thanks for the feedback on the audio. So, and we'll keep laying the groundwork here as far as how the contribution rules work generally, and then we'll field some of these questions. So thank you for your patience, and don't hesitate to keep asking more questions. So the first type of contribution is an employee pre-tax contribution. So an employee contribution, another name for that is a salary deferral. So the limit is 100% of your self-employment compensation, which remember that is line 31 of Schedule C, less 1/2 of the self-employment tax. So you can do dollar for dollar, not to exceed $19,500, or an additional $6,500 if you're 50 or older. So that's the 2020 limit, and the limit didn't change for 2021, so it remained the same. Now, you need to reduce that by any contributions that you made to another plan. So if you have a W-2 job and that side business, and in your W-2 job, you have a 401k plan that you're making contributions to, if you max it out to the day job, you're not going to be able to make any more employee contributions to the solo 401k because the employee limit applies at the employee level. So it's aggregated across all plans. If you contribute $10,000 to your day job and you've got enough self-employment income to justify it, you could contribute another $9,500 to the solo 401k. And we'll see in some of the examples how that works, but that's the general concept. Of course, one exception is if you are participating in a 457 governmental plan. In that case, those contributions are not aggregated. So you could also make that employee contribution, that salary deferral, as a Roth contribution. Again, it's the same limit, 100% of your self-employment income up to $19,500 or an additional $6,500 if you're 50 or older. You could do a mixture. You could do some pre-tax, you could do some Roth. If you're going to make a Roth employee contribution, it needs to go into a Roth sub-account. So it needs to go into a separate bucket. Next, we've got employer contributions, which are sometimes called profit-sharing contributions. So the limit there is, again, you start with the self-employment compensation, which is line 31 of Schedule C, less 1/2 of the self-employment tax. So once you've done that pre-calculation, you're able to contribute 20% of that amount as an employer contribution. An employer contribution is always a pre-tax contribution. Now you need to keep in mind the overall limit, which for 2020 is $57,000 or $63,500 if you're 50 or older. For 2021, it goes up to $58,000, or you can go up to $64,500 if you're 50 or older. So if you, even if you have a very high self-employment compensation, and if 20% is more than this amount, or if you're also making, say, other types of contributions like an employee contribution, you want to make sure that you don't exceed that overall limit. The next point in the next bulleted point here is that it's not impacted. So unlike the employee contributions, where you consider those employee contributions that you make to another plan, employer contributions, the limit is at the employer level. So you don't worry about contributions made to another plan. The one exception is if those contributions were made to a 403B plan. In that case, you do need to consider the contributions made to the 403B plan to see if you've met the overall limit, the $57,000 or the $58,000 limit, for example. Our next slide here, we talk about voluntary after-tax contributions, which is really the key or one of the core elements of the Mega Backdoor Roth. So here, the limit is the lesser of your self-employment compensation or the overall limit, which is $57,000 for 2020 or $58,000 for 2021, reduced by any employee or employer contributions that you made to the plan. You know, so if you put in $19,500 as an employee, $20,000 as an employer, you know, that's going to be $49,500. So you could do the difference, the $8,500, assuming that you have the self-employment compensation to justify it, as an after-tax contribution. Note that the limit does not go up if you're 50 or older. That overall limit actually doesn't go up. What it is that you ignore the catch-up contribution. So effectively, you can contribute more, but not as an after-tax contribution. And we'll see that with a couple of the scenarios and examples that we give. So like the employer contribution, it's not impacted by any contributions made to another plan, like a day job 401k plan. One exception would be the 403B contributions. You got that 403B exception. So you do need to consider 403 contributions for purposes of determining whether you've met this limit. And like the Roth contributions, those after-tax contributions need to be deposited into a separate sub-account. That's how you could end up with 3 accounts for each participant. You might have a pre-tax account, a Roth account, and then a voluntary after-tax account. And you'll see as we go through the slides, we really try to illustrate that. But that's one of the fundamental points there. So now, next we're going to turn to contribution scenarios. But before we do that, I want to field some of these questions. So thank you so much for taking the time to ask those questions. So the first one here is, I'm setting up a Coinbase Pro account to invest in cryptocurrency in my 401k trust name. How do I name the Roth Solo 401k account since I've already named the first account? So great question. So in that case, you could just simply put Roth in parens. It's really technically for your benefit. So the key is that each account is set up in the name of the plan and under that EIN number for the plan, and that you're keeping the money in separate segregated accounts. So if you have a pre-tax account and then you also want to have Roth funds, you would need a separate account in the name of the plan and under the EIN number. You could put Roth in parens just to help you remember. Next question, can you comment on how rules address a spouse as sole employee of LLC? So I gather from this question that you're asking about how a spouse could also participate in the plan. So you can have a solo 401k where you actually have multiple participants, where one is one spouse and the other participant is the other spouse. Each spouse would need to work in the business and to report their own self-employment income. So in that case, you might have each spouse filing a Schedule C, for example, in this sole proprietor type scenario. In that case, each spouse is going to have their own separate sub-account, and each spouse's ability to contribute to the plan is going to be based on the factors that apply to that spouse. So going back to the factors page, so you have, what is that spouse's Schedule C income? What is that spouse's age? Does that spouse participate in another plan? What type of contributions does that spouse want to make? Pre-tax, employee, Roth employee, employer, voluntary after tax, down the line. So thank you for that good question. Hopefully that gives you the information you're looking for. Next question, any IRS guidance issued on employee contributions for plans created after the end of the calendar year but before the return is filed? So no, they haven't published any guidance yet on that. So the conservative approach is that if you didn't set up the plan until after the end of the year, that you could still make the employer contributions, but it would be prudent to wait to see if they give you the guidance about making the employee contributions. Next question, what if you're an LLC filing as an S Corp? Great question. So there, what's really going to dictate it is the tax status. So then you would follow the rules that apply for S corporations. Remember, S corporation is really just a tax status. You could have a corporation taxed as an S corporation. You could have an LLC taxed as an S corporation. In that case, it's going to be based on the W-2 wages that you receive from the S corporation. And I would encourage you to look at watch the presentation from last week, which you can find the link to the recording on our YouTube channel. Next question, how do you report the Mega Backdoor contribution to the IRS? Get 1099? So the actual contribution piece is not reported. And you'll see that that's one of the slides that we address is reporting. What is reported is when you convert it. So for example, you might make a 2020 contribution if you set up the plan before the end of December 31st, 2020, anytime up until your business tax return deadline. So April 15th or October 15th, if you filed a timely extension, if you're filing as a sole proprietor. But then you might do that in 2021 because that's when the deadline is. But then you convert the money from the after-tax account to the Roth account. So that's going to be a 2021 reportable event. So you would get a 1099-R issued at the beginning of 2022. So the contribution is not reported, but the conversion is. Next question, can I just put money in the 2 post-tax accounts and not the pre-tax account? I'm 50, what is the max I can put into the 2 post-tax accounts? So you'll see, yes, you can. You don't have to put money into the pre-tax account, and we will address that in the scenarios, in one of the scenarios that we go through. So, I mean, the max that you can put is going to depend on your the factors, and I think the scenarios are going to address your situation. So thank you for that good question. Does a minor child, next question, does a minor child W-2 employee disqualify from having a solo 401k? Yes, you got to be 21 years of age or older. So next question is, sorry, my question above where I said 25%, actually don't see the first question. You said, I don't see a question above, but you're saying, sorry, my question above where I said 25% was in reference to your slide at the time where it said 20% is the max for employer contributions. So the rules are different. If you watched our S corporation presentation, the employer contribution limit is 25% of the W-2 wages that you receive from the S corporation. For if your business is taxed as a sole proprietor or a single member LLC, Schedule C income, for example, you get a 1099 miscellaneous and you put it on Schedule C, the employer contribution that you limit is 20% of your self-employment compensation. So you first do that pre-calculation, your net income from line 31 of Schedule C less 1/2 of the self-employment tax, and then 20% of that number is the employer contribution limit. So we covered it here in this slide. So for employer profit sharing, next question, for employer profit sharing, can I put part in Roth IRA and part in solo 401k? So you definitely cannot put it into a Roth IRA. This is all 401k contributions. But Above and beyond that, employer contributions are always pre-tax contributions. So they always go into the pre-tax sub-account. But if you are not inclined to make pre-tax contributions, as you'll see as we go through the scenarios, you could decline to make a profit sharing contribution and just focus on making Roth contributions and after-tax contributions. So that brings us to the end of that batch of questions. Please don't hesitate to ask more questions. We'll start going through the scenarios now. So to set the stage for that, we've got, we're going to start out, the way that we're going to approach this is we're going to have a base scenario, and then we're going to change the different assumptions to really illustrate the points. So we first start out with the base, and then we'll go through and change different assumptions. So the base is someone who is self-employed. Their business is taxed as a sole proprietor, a single member LLC. They're an independent contractor, one of the above. Or it could be multiple sources of self-employment income if they've got multiple 1099 miscellaneouses coming in. It's a one person. They're under 50 years of age. They don't make contributions to another plan. Their goal is to first maximize the pre-tax contributions and then make Roth and or voluntary after-tax contributions. And they have $100,000 of self-employment compensation. So they've done that pre-calculation where they've taken line 31 of Schedule C, less 1/2 of the self-employment tax, and that has produced a $100,000 figure. So how much can this person contribute? So remember, they want to first start out with pre-tax so that they can make a $19,500 pre-tax employee contribution. Because remember, the limit is 100% of self-employment compensation up to $19,500. They could then make an employer contribution of 20% of their self-employment compensation. So that would be $20,000. So then they could make the difference up to the overall limit. So that would be $17,500 for 2020 or $18,500 for 2021 as a voluntary after-tax contribution. Now let's change one of the assumptions and see how it plays out. So let's assume that instead of having $100,000 of self-employment compensation, remember that's where they take their net income on line 31 of Schedule C, less 1/2 of the self-employment tax. So let's drop that down to $50,000 and see what happens. So in that situation, they could still do 100% of their self-employment compensation up to $19,500. So they could do that as a pre-tax, because their goal is to do pre-tax first. Then they could do 20% of their self-employment compensation. So that'd be $10,000 now, because we changed it from 100 to 50 as an employer pre-tax contribution. Remember, employer contributions are always going into the pre-tax bucket. And then they could do the difference as an after-tax contribution. So that would be $20,500 for 2020 and $20,500 for 2021. Because remember, the limit is the lesser of their self-employment compensation or the overall limit. So here, their self-employment compensation is less than 57. So they're still going to be capped at 50 for each year. And then they can move that after-tax money into the Roth bucket. So at the end of the day, they'd have $29,500 in their pre-tax sub-account and $20,500 in their Roth sub-account. Now let's go back to the base, but now let's change something else. Let's change the scenario to this person contributes $19,500 to their day job plan, and let's see what happens. So in this situation, they've already maxed out their employee contribution bucket. They filled it up at their day job. Let's say they were trying to get a match from their employer plan. So they cannot make any more employee contributions to the solo. This person has $100,000 of self-employment compensation. They still want to maximize the pre-tax first. So let's say they put in $20,000 into their pre-tax sub-account as an employer contribution. Employer contributions are always pre-tax contributions. Then they could do the difference up to the overall limit because their self-employment compensation is greater than the overall limit. So that's overall limit is the limit. So that would be $37,000 as a voluntary after-tax contribution for 2020, and then $38,000 for 2021 since the overall limit went up to $58,000. So they could then move that money from the after-tax account to the Roth account. So they might have, in that situation, they would have $20,000 in their pre-tax account and $37,000 in their Roth account. Okay, so let's go back to the base and make a different change. Here, now let's start assuming, and I think this will address one of the questions from the comments. Let's assume now that the person is not interested in making pre-tax contributions. They really want to focus on the Mega Backdoor Roth contributions. So how does this play out? So let's assume this person then, they put in 100% of their self-employment compensation up to $19,500 as a Roth contribution, as an employee contribution. They decline to make employer contributions because those are always pre-tax, and they're not interested in making pre-tax contributions. And then they could do the difference up to the overall limit, which would be $37,500 for 2020 or $38,500 for 2021 into their into their after-tax sub account. And then they could move those after-tax contributions into the Roth account. So at the end of the day, they're going to have $57,000 or $58,000 for 2021 in their Roth sub account. Okay, let's go back to the base, and now we're going to change a couple of factors and see how things play out. So now we're saying this is a scenario where it's two participants. Let's say it's two business partners or a husband and wife. Let's say they're both realtors and they don't have any W-2 employees working for them, so they're able to set up a solo 401k, but they file Schedule Cs. They have $100,000 of self-employment compensation after they run that pre-calculation. So really, it's the same limits as the first scenario, but the point here is that each person can make those contributions because each person is able to make contributions based on their respective self-employment compensation. So in this scenario, each person contributes $19,500 as an employee pre-tax contribution, $20,000 as an employer pre-tax contribution, and then the difference, $17,500 for 2020, $18,500 for 2021 is an after-tax contribution, and then could move it over into their into their Roth sub account from the after-tax to the Roth. So in that situation, they'd have $39,500 in their respective pre-tax sub accounts, and then $17,500 in their Roth account, or $18,500 for 2021 in their Roth account. Okay, so here let's go back to the base scenario, but this time we're going to change the age. So now we have someone that's 50 years or older. How do things change? So the person has $100,000 of self-employment compensation. They want to first maximize the pre-tax employee contribution. Now they can go all the way up to $26,000 because they have that $6,500 catch-up. They can still make that employer pre-tax contribution of $20,000, and they could still make the after-tax contribution of $17,500 for 2020 or $18,500 for 2021. And I see we've got some more questions that have come in. Thank you so much for asking. We'll go through these scenarios and then we'll take the next batch of questions. So now let's go back to the base again, and now let's change something else. Now we're going to change to the factor where the individual contributes $19,500 to their day job plan. But let's assume now their goal is to maximize the Roth and/or voluntary after-tax contribution. So because they've already maximized their employee contribution by maximizing the contributions to their day job plan, they cannot make any more employee contributions to the solo 401k. They decline to make employer contributions because, again, their goal is to maximize the Roth and/or voluntary after-tax. So here they just make a full $57,000 for 2020 or $58,000 for 2021 contribution to the voluntary after-tax sub-account. And then they can move it from the after-tax account to the Roth account. So at the end of the day, they've got $57,000 or $58,000 for 2021 in their Roth solo 401k sub-account. Okay, next scenario. Let's assume now that if this person is 50 years of age or older, they contribute $26,500 to their day job plan. And again, their goal is to maximize the Roth solo 401k or voluntary after-tax contributions. So same scenario, they cannot contribute any to the employee because they already used the bucket. They already made the contribution to their day job plan. They decline to make the employer contribution because their goal is to maximize the Mega Backdoor Roth contributions. So same scenario, they contribute 57 or 58 for 2021 as a voluntary after-tax contribution. So the point here is that the limit doesn't go up just because they're 50 or older. So they'd still be limited to that 57 or 58, then they could move that from the after-tax to the Roth account. Okay, now we're really going to start to change the factors. So here we have two participants. They each contribute to the day job, to $19,500 to their respective day job plans. The goal is to maximize the Mega Backdoor Roth contributions, and they have $100,000 each of self-employment compensation. So they cannot make any employee contributions. They decline to make employer pre-tax contributions because those are always pre-tax and they want to maximize the Roth. So they, again, make $57,000 as an after-tax contribution to the solo 401k, or $58,000 for 2021. And then they can move that from the after-tax account to the Roth account. So the point to convey here is that this is for each person. Because again, each person can make this contribution because each person has the self-employment compensation to justify the contribution. So before we get into the next set of slides, which is the mechanics of how to make contributions, the reporting, etc., we'll field another set of questions. Thank you so much for taking the time to ask those questions, and don't hesitate to ask more. Okay, so the next one that came in was, if my spouse is the only employee in my LLC and receives W-2 from me, does she need to file a Schedule C? Can her after-tax contribution be equal to her total income from the LLC? So she would really need to have some type of self-employment compensation to justify that. Of course, how to report her W-2 wage, her self-employment compensation is a question for your tax advisor. But the starting point is always having the self-employment compensation to justify the contribution. That was a good question. Can you roll pre-tax solo 401k contributions to the solo 401k Roth or solo 401k after-tax accounts? So you could transfer money from a pre-tax account to a Roth account. So there it is. Can you roll pre-tax? Yep. So the question is, can you move money from a pre-tax account? Really, the question was phrased as, can you move pre-tax contributions to the Roth account or the after-tax account? So you wouldn't move it to the after-tax account, but you can move money as much as you want from the pre-tax account to the Roth account. So for example, you might make a pre-tax contribution for 2020 because you set up the plan before December 31st, 2020, or even if you did it, if you're making an employer contribution and you set it up before your business tax return deadline in 2021, and then you can move that money as a pre-tax amount from the pre-tax account to the Roth account. Really, there's no limit on how much you can convert from a pre-tax account to a Roth account. And so that would be taxable in the year of the conversion. So you might be making the contribution for a prior year because you're doing it by the business tax return deadline. But like, let's say you make the contribution for 2020, you reduce your 2020 taxes, but then you convert it in 2021. Now that's going to be taxable in 2021. So effectively, you're just moving that income from reporting it in 2020 to now reporting it in 2021. The next question, am I disqualified to have a solo 401k if I hire part-time W-2 with 600 hours per year? No, but under the Secure Act, starting in 2021, if you have a non-owner W-2 employee that works 500 hours per year or more for 3 consecutive years, you can no longer maintain the solo 401k. How does Social Security income factor into this? You have to have really earned self-employment income. So that you wouldn't use that as a basis to make a solo 401k contribution. How does a stock distribution from a stock option being exercised after that company was sold? So I'm gathering that you're asking whether you could use a dividend paid on a stock as a basis to make a solo 401k contribution. So again, you've got to have earned income as a basis to make a solo 401k contribution. Dividends on stock are inherently investment income. You cannot use investment income as a basis to make a solo 401k contribution. So it's got to be that. You always start out with your earned self-employment income. The idea is that the 401k is used to make for a person who has earned income to make contributions to save for retirement, not for investors to be able to take their investment income and put it into a retirement account. So it's got to be that earned self-employment income as a basis and the starting point. Can I have 1099 resources and still qualify for a solo 401k? Yes, you can. You can have, if you have 1099 contractors working for you in your business, that will not stop you from having a solo 401k. The issue is if you have non-owner full-time W-2 employees, where full-time means someone that works 1,000 hours a year or 1,000 hours or more per year, or 500 hours or more per year for 3 consecutive years starting in year 2021. The next question, so the $6,500 catch-up for 50 years old can't be allocated to the company pre-tax contribution after putting in $57,000 in the post-tax account. So yes, it would be possible. So under that scenario, though, you would have to, so I understand that the person in this scenario, they want to make a $57,000 after-tax account, after-tax contribution to the after-tax account. But then on top of that, they're 50 or older, and they also have a $6,500 catch-up contribution they want to make. So assuming that they have the self-employment compensation to justify it, and assuming that they haven't already used that employee contribution limit, because let's say they didn't make that employee contribution to their day job, you could make that $6,500 catch-up contribution. Catch-up contributions are always made as employee contributions. So they would go into either the pre-tax account as a pre-tax employee contribution, or it could go in as a Roth employee contribution. Hopefully that helps. Next question, can you contribute to a personal Roth IRA, assuming your AGI is within the limits, in addition to maxing out the Roth 401k employee contribution and the voluntary after-tax contribution? Yes, you can, assuming that you have the self-employment compensation to justify it. So you don't have those same AGI limits that apply to the Mega Backdoor Roth Solo 401k that you do if you're considering making Roth IRA contributions. Okay, so thank you for all those questions. We'll keep going through the slides, and please don't hesitate to ask more questions, and we'll answer them all. How do I make contributions? So now we're going to turn to the mechanics of making contributions and converting and reporting the converted amounts. So you've got different options. You could simply write a check payable to the name of the plan and write annual contribution in the memo section of the check and deposit it into the applicable account, right? The pre-tax, Roth, or after-tax account. It's also acceptable to electronically deposit the money. So in that situation, you would check with the financial institution that holds the accounts to determine their process to receive incoming electronic deposits. Now note that in terms of the brokerage firms where you might have your solo 401k sub-accounts at, Fidelity, they generally don't allow for incoming electronic deposits with the exception of Fidelity. Each participant, so you've got multiple people participating in the solo 401k, like the husband-wife scenario, would deposit their contributions into their separate sub-accounts. So you could end up with 6 sub-accounts in that husband-wife scenario, a pre-tax, a Roth, and a voluntary after-tax for each participant. When is the deadline to make the contributions? So assuming that you set up the plan before the end of December 31st or before December 31st, 2020, that would have preserved the right to make contributions all the way up until your business tax return deadline in 2021. So if you're taxed as a sole proprietor, single member LLC, independent contractor, etc., where you're reporting the income on your 1040, then your business tax deadline is going to be the 1040 deadline. So that's April 15th or October 15th if you file a timely extension. And there's some confusion out there, but this is clear based on IRS publication 560, which really is the landmark guidance for retirement plans for self-employed people like solo 401ks, where they confirm on page 3, there's a chart on page 3 that confirms that deadline. How do I report the contributions? So it depends on what type of contribution you're talking about, but if it's a pre-tax employee contribution, it's going to go on line 15 of Schedule 1 of your 1040. If it's a Roth contribution or a voluntary after-tax contribution, it doesn't go on the 1040. The employer contributions would also go on that same line. So really the takeaway here is if it's a pre-tax contribution, it goes on the 1040 because you want to, of course, reduce your taxable income. How do I convert after-tax to Roth? So you've got multiple options. You could do it by check. You could do it by wire. You're going to want to, again, check with a financial institution that provides your account to determine their own procedure to move money in between accounts electronically, if that's your preference. You could even move money between a bank and a brokerage. So let's say that you have, 3 brokerage accounts at Fidelity, a pre-tax, a Roth, an after-tax, and you want to invest some of the money in cryptocurrency. So in order, those cryptocurrency accounts need to be funded from bank accounts, not brokerage accounts. And that's because of the brokerage account rules. But so you would need to move the money from the after-tax account, you could move the money from the after-tax sub-account at the brokerage to a Roth bank account. So to convert it from the after-tax to the Roth, go from brokerage to bank, in order to then fund the crypto account, right? Because you want to fund it with, of course, fiat money, but from a bank account. So you could fund that Roth solo 401k sub-account at the cryptocurrency exchange with money from your Roth solo 401k sub-account at a bank. The other point here is that you could transfer the money from the after-tax sub-account to the Roth solo 401k sub-account, or you could also go to a Roth IRA. So these next few pages, we talk about the steps to convert from an after-tax to a Roth for different institutions where it's very popular to have these accounts at. So the first one here is Schwab. So the process would be you would open the Schwab brokerage account, and that's part of our process. We prepare the paperwork to open up the different brokerage accounts like the pre-tax, the Roth, the after-tax sub-account. You make your voluntary after-tax contribution to that brokerage account, and then you convert it. You could go to the Roth sub-account, so the brokerage account at Schwab for Roth solo 401k funds, or you could go to a Roth IRA. It could be at Schwab or it could be at a different institution. Now that transfer, that conversion to the Roth account is a reportable event. So you want to let us know about that so we can gather the information that's needed so that we can generate that 1099-R. And depending on whether you're going to a Roth solo 401k or a Roth IRA, you want to go to our website. If you go to mysolo401k.net, go into the Learn menu, and then click on Forms, and you'll see there's one online form for after-tax to Roth solo 401k, and then another for after-tax to Roth IRA. Fidelity, it's a very similar process. You have the brokerage account for your after-tax money at Fidelity. You deposit the contributions into that brokerage account. You convert it either to the Roth solo 401k or a Roth IRA. And then you let us know about that conversion so that we can gather the information that's needed to generate the 1099-R. Again, clicking on Learn, then Forms, and then clicking on the applicable form. TD is a popular place where a lot of our clients have their accounts, and we prepare the paperwork to open up those accounts there. So it's the same process at a high level, right? You contribute to the after-tax sub-account, convert to the Roth Solo 401k, or it could be a Roth IRA, a TD, or a different institution, and then submit the applicable form so we can gather the information needed to issue the 1099-R. Now, in deciding, and I see we've got some more questions. Thank you so much. We'll go through a few more slides and then we'll address those. So in deciding whether to go to a Roth IRA or a Roth Solo 401k, we have pulled together some of the factors and differences to help you decide. So a Roth IRA is not an employer plan, so distributions can be made at any time. Roth IRAs are not subject to required minimum distributions. You, however, cannot take a participant loan from an IRA, any type of IRA, whether it's a Roth IRA or traditional IRA. With respect to a Roth Solo 401k, you've got to meet a triggering event in order to take distributions. So generally, that means you're age 59 and a half or older. Solo 401k plans are subject to RMDs. So what some people do is they have a Roth Solo 401k. Before they hit the required minimum distribution age of 72, they move the money over to their Roth IRA before the end of the year. So they zero out that account, so there's no RMD that applies. Lastly, plan participant loans are permitted. So you can always take a loan from a Roth Solo 401k. You can't take a loan from any type of Roth IRA. And then, of course, another thing to add is just the ability to invest in alternative investments like real estate or cryptocurrency, et cetera, is much easier inside of a Roth Solo 401k. You have direct checkbook control over your money. Whereas with a Roth IRA, you really need that LLC underneath it in order to have the checkbook control. There's no deadline. So we talked before about the deadline to make the contribution, but there is no deadline to convert the money. The conversion is reportable for the year of the conversion. So for example, you might make an after-tax contribution for 2020 in the year 2021, like by April 15th or October 15th of 2021, if you file a timely extension, and then convert those 2020 contributions in 2021. So the 1099-R will not be issued until 2022 because it's really driven by the year of the conversion. Now, when it comes to that 1099-R, that's going to include the amount converted. So that might be the contributions and any gains. Again, it's reportable for the year of the conversion. Now, you would then take that converted amount and you would report that on your 1040 for that year. So line 5A and any gains on line 5B. Again, like we talked about in the prior slides, you need to let us know about the amount that was converted so we can gather the information needed to generate that 1099-R. You can go to mysolo401k.net, click on the Learn menu, then click on Forms, and you'll see the links to the applicable forms to submit that online form. So here we'll take some more of these questions, and then we'll finish up with the final set of slides and any final questions. Okay, so downsides of transferring to Roth IRA versus just leaving in the Roth 401k. So we had that slide that might have addressed your good question there, but really the downside of transferring to the Roth IRA, I would say, is you're going to lose some of the features, right? Like the ability to take a loan. You're going to lose the ability to easily invest in alternative investments. And once you go to a Roth IRA, you cannot come back because you can't transfer money from a Roth IRA to any type of 401k, including a solo 401k. Next question, can multiple members of an LLC who want to set up a solo 401k plan have different plans in order to customize which participants receive employer contributions and which do not? So it would just, if it's one entity and you've got multiple partners, you would just have one plan as long as the entity doesn't have any full-time W-2 employees working for it, non-owner W-2 employees. And it would still be considered a, quote, one participant plan, because one exception to that one participant requirement is other owners of the business. So as long as each owner's working in the business, reporting self-employment income, they could each participate in the plan. And so the testing rules that apply to 401k plans generally don't apply to a solo 401k plan. So that means that you don't have to have the same amount of contributions for each person. You could have different contribution amounts, and you're not going to violate a testing rule because they don't apply to one participant plans. Okay, we got a follow-up question here about the deadline. So didn't they change the deadline to establish a solo 401k to the due date of the return? So let's see here. Not the end of the tax year. So they tried to do so, but they didn't execute it in the sense that there is a IRS. So the Congress changed the rule under the Secure Act. They changed the deadline, but there still was the outstanding IRS guidance, which effectively means the conservative approach is that if you didn't set up the plan until after December 31st, 2020, you could still make employer contributions anytime. If you do it before your business tax return deadline, so April 15th or October 15th, you could still make the employer contribution, but not employee contributions. Now, there's a chance that the IRS may change and update their guidance so that would eliminate that issue, and so you could make both types of contributions as long as you set it up before your business tax return deadline. Next question, can you roll over existing 401k account balances to a solo 401k? Yes, if it's coming from a former employer plan. Generally, if it's in a current employer plan, you're not going to be able to roll it over until you leave your job. But check with your administrator because they could have set up the plan with a certain way, or you might have certain types of money that you can roll over. But that's the general rule. So do I have to move SEP IRA to solo 401k pre-tax? So if you choose to roll over your SEP IRA, you can roll it over to the solo 401k. SEP IRA funds are, of course, pre-tax funds, so they would go into the pre-tax sub-account. But I think you were given, their next comment was more of explanatory, which we addressed that question. So let me know if your question is not addressed. So what are common mistakes people make using Mega Backdoor? Now, that's a great question. I mean, I would just say this presentation hopefully nips a lot of the issues in the bud, but it's going to be things like, some of your bigger issues are not putting the money into separate sub-accounts, not reporting the conversion, of course, over-contributing, things like that. Next question, can cryptocurrency be bought from a private party to be transferred into any of the 401k plans? So yes, you can buy, you don't have to buy cryptocurrency on an exchange. You can buy it outside of an exchange, provided that you buy it from an unrelated person. You want to make sure that you're otherwise, of course, following the rules when it comes to cryptocurrency investing. Let me catch up to these questions here. Did you say that no more pre-tax income can be contributed into a solo 401k plan after January 1st, 2021? No, we did not say that. So if you set up the plan before December 31st, 2020, that preserved the right to make 2020 contributions, all types of contributions, up until your business tax return deadline in 2021. Yes, you can roll over money from a former employer plan into the solo 401k. Next question, if someone hires their spouse as W-2 in their business that generates 300,000, can you contribute the max 114? So their ability, if the spouse is also working in the business and reporting their own self-employment income, subject to all the other factors like their age, whether or not they contribute to another plan, then yes, they can both contribute. And we addressed that in one of the scenarios. So it would be based on each person's, just with respect to the follow-up comment and question there, it would be based on each person's respective self-employment income and their other factors like their age, whether they make contributions to another plan. So, you know, like they would each have their own Schedule C, for example. Okay, so thank you for all those great questions. We're going to keep going through the slides. So these examples here talk about the different holding accounts. So really the illustrations here just highlight the fact that you've got these multiple sub-accounts. So you might have a pre-tax account because you want to roll over money from a former employer plan, which is pre-tax money. You've got the Roth account because you want to make Roth contributions, and you've got the after-tax account because you want to make the Mega Backdoor Roth contributions. So each account is opened up under the name of the plan for the benefit of the participant, under the EIN number of the plan, and you've got it separate and segregated for pre-tax, Roth, and after-tax funds. This next slide really illustrates how you might have two participants, each with their own set of 3 accounts, pre-tax, Roth, and after-tax. So we've got a set for Jane and a set for John Doe. Here, this slide really illustrates the conversion. So in this scenario, you might have the person contribute pre-tax money to the pre-tax account, and then they want to do the after-tax money into the after-tax account, and then it goes from the after-tax to the Roth. So this would be the scenario where the person first wants to maximize their pre-tax, you know, and then everything that's left over goes into the after-tax sub-account, and then they convert it to the Roth. So it doesn't go directly to the Roth, it first goes to the after-tax account. This next illustration illustrates really going to a Roth IRA. So if the person first wants to maximize their pre-tax contributions, employee and employer, then they want to use the rest of their limit as an after-tax contribution. But instead of going to the Roth Solo 401k, let's say they want to go to a Roth IRA. So in that situation, it would then move over to that Roth IRA account. So we have a wealth of information on our website. We would encourage you to visit the website. We'll include links to that information in the YouTube comments. And please like this video. Please subscribe for more videos like this, and you'll get notification of our weekly webinars. I really appreciate everyone's participation with the questions. We do have more time if you want to ask more questions. And we've got at least one more that came in. So you can combine employee pre-tax elected deferrals with employer contributions into one pre-tax sub-account. Yes, you can. You don't have to split the accounts. You would just have both types of contributions going into that same account. And you could also have pre-tax money that you rolled in from a pre-existing account, like say a pre-tax IRA or pre-tax employer funds. And we do have this little bonus image here where we talk about the process. You know, you make the contribution to the designated account, the conversion form, you move it over to the Roth IRA or Roth Solo 401k. So you want to submit that form online, and then we issue the 1099-R by the following year. So I think, oh, we've got another question here. So can you talk a little about Solo 401ks with a loan component? Sure. So you have to have a 401k plan that allows for a loan feature. It has to be properly documented. So at the time that you take it, you have an amortization schedule, you've got the note. So you can only borrow up to 50% of the balance, not to exceed $50,000. It has to be paid back in equal payments of principal and interest. The interest is going to be prime plus 1%, or it could be a CD rate plus 2%, with those payments spread out over a 5-year term. And we prepare the loan documents as part of our services. So I don't see any more questions. Thank you. Thanks again, everyone. We really appreciate all your participation and with today's presentation. Thank you so much.